Hello and welcome to interest.co.nz. I'm Gareth Vaughan and I'm joined by Lloyd Kavanagh, who is a partner at Minter Ellison Rudd Watts and a specialist in securities law. We're here to talk about the Financial Markets Conduct Bill, which is a huge piece of legislation currently working its way through the parliamentary system. Now, Lloyd, this bill has been described by Craig Foss, the Commerce Minister, and his predecessor, Simon Power, as a once-in-a-generation opportunity to overhaul the financial markets regulation and improve efficiency, and as being critical to restoring investor confidence in the financial markets. Is it really that big of a deal?
Yeah, it's a huge deal, Gareth. Basically, it's a complete rewrite of New Zealand's securities law. So the current Securities Act 1978 obviously has been around for more than 30 years. It's a go back to basics, fundamental change. People will see it, first of all, in public offer documents, and also the introduction of licensing regimes for some participants in the New Zealand capital markets who have not previously been licensed. So it's enormous.
And what will it mean for the ma and pa investor?
I think that change to offer documents will be the main thing that they will actually notice. So the fundamental change is, compared to the current investment statement and prospectus, in future there will be what's called a PDS, product disclosure statement, and an online register. Now, the product disclosure statement is intended to be simplified, to have a front 2 pages which explain the basics, and then to answer a whole set of questions that will be set out in regulations in clear, concise and effective language. But then the replacement of a prospectus, a written document as such, by an online register will be a huge change, and really quite market leading in the world, I think.
But all the key information will still be in that document?
The requirements are going to be that the basic information is in the PDS, but the all material information, all the details, are going to be in the online register. So that means that for retail investors, the document they will get should contain the information they need to make basic investment decisions. But for analysts and experts, they will be looking to this online register, which is like a website.
And there must be some fairly major changes that directors are going to face as well through this legislation.
Yeah, I think if I was a director of a company involved in the investment management or other financial product issuers, I'd be really concerned that the management team were getting onto this now. The expectation at the moment is the regime will go live around about April next year. And there are 2 big areas that directors need to be thinking about. The biggest issue is the strategic one. How will it impact on what they do by way of business process and their competitors? Because I think it does change the landscape. And then secondarily, what does it mean for them in terms of the detail of their particular responsibilities in terms of the content of documents and conduct? But it's really that first issue that they should be thinking about and asking questions about right now.
Now, I assume also the Financial Markets Authority is going to have some new powers through this bill. What areas in particular will it have new powers in, and how significant will these be?
I think the biggest thing for the FMA is going to be its new role in licensing for the first time in New Zealand fund managers and also the providers of discretionary investment management services, which the legislation refers to as DIMS. That's going to be a massive job for them to get underway as soon as the legislation's in final form. And we know from the licensing of securities trustees last year, of whom there are relatively few, this will be a lot of work both for the FMA and the industry. And then the second thing that is a major change to the FMA's powers is it will have a power under the new legislation to reclassify things as financial products or securities, so that the kind of issues that arose in blue chip, where you had things that were constructed with the intent of being outside the regime, they will have the power simply to go and say, hey, guess what, we're bringing you inside the regime, and from now on you're going to comply. In terms of their other powers, most of those are already in place with their own Financial Markets Authority Act, which has been around for a couple of years, though there are some changes of detail there.
In terms of that power to pull things in that are perhaps outside securities laws at the moment for the FMA, is that at the FMA's discretion?
That will be the FMA's decision. Of course, they'll have to make it on reasonable grounds and with objective consideration of the factors. But yes, they will have a broad power to reclassify things that fall outside the technical words of the definitions and bring them in, or to reclassify them from one of the categories of securities into another category if they think that's appropriate. And that's one of the things that we're all waiting to see how that will work in practice. For example, if securities have already been offered or are in the process of being offered.
And there are some things that have been added to this bill in reaction to Ross Asset Management. What in particular have they done, and to what extent might it prevent a sort of Ross Asset Management type debacle happening in the future?
So the biggest thing that's relevant to the Ross Asset Management scenario is something that was already in the bill, but it's been enhanced, and that is moving the regulation of DIMS, that is Discretionary Investment Management Services, out of the Financial Advisors Act regime into the product regime in the Financial Markets Conduct Bill, so that it's much more similar to the regimes that apply to other products like unit trusts or KiwiSaver schemes, and is going to be comparable to the managed investment schemes. So that's a really big change. But and the bill has details which are yet to come by regulation, which we are expecting them to respond to Ross Asset Management. The other thing which is of interest, and I think comes out of Ross Asset Management, is the proposal in the bill that was added only a few weeks ago when the SOP came out, is to apply the trust account provisions that are currently in the Financial Advisors Act for brokers to people providing those types of services to the wholesale market as well as to retail clients. So I think people are still getting their heads around what that will mean.
And what about KiwiSaver providers? How are they going to be impacted by these changes, and what will it mean to, I guess, KiwiSaver members?
I think the biggest change for KiwiSaver providers is going to be this licensing of fund managers for the first time. The detail of that regime, yet again, we're waiting for the Ministry to produce. But every manager of a KiwiSaver scheme is going to be applying between now and whenever the legislation goes live to be licensed, and the FMA will be considering their fitness for purpose, the way in which they operate, and those will be really quite big challenges for KiwiSaver providers, especially the smaller ones.
And what about for banks and I guess non-bank deposit takers, finance companies? What's in this legislation that matters to them?
Well, for banks, for their core products, there's not a huge amount of change in terms of the offering requirements. So registered banks at the moment are required by the Reserve Bank to produce a disclosure statement, and on that basis they're exempted from the prospectus requirements. They'll continue to have exemptions of that type going forward. But the bill has a whole new section in it about derivative products, and with a specific regime, if they were to choose to offer derivatives to members of the public, that will be more straightforward than it is at the moment, where there's no specific regime. The other big impact, I think, for the banks is each of them own fund manager subsidiaries, and they're really going to be impacted by these new regimes for the managed investment schemes and the discretionary investment management services.
Now, obviously, one issue that's behind all these changes was the collapse of so many finance companies in recent years. To what extent would this bill, if it had been in place before then, have prevented or reduced the number of companies we saw collapse and the losses that hundreds of thousands of investors had in those collapses?
Gareth, that's a really interesting question, because a lot has happened since then. The first thing is we've already got in place the Reserve Bank's non-bank deposit taker regime, and that introduction of Reserve Bank oversight really, I think, has made the biggest difference. The other thing I'd say is some of the conduct that went on with those finance companies was simply dishonest conduct, and people are being convicted of offences under the Crimes Act. Frankly, that behaviour was illegal then and will continue to be illegal. But I think the main difference will be the change to the disclosure documents, where one hopes that investors will have a much clearer idea of what it is that they're investing in and what the risks are.
Thanks for that, Lloyd. That's Lloyd Kavanagh, who is a partner at Ellison, and I'm Gareth Vaughan at interest.co.nz.
Thank you, Gareth.